Thank you everyone for joining FinMedium's Investor Talk. I am Shaina and I'll be hosting this talk with Mr. Vivek Mashrani. So for whoever is familiar with the investing world, with stock markets, Vivek's name is not unfamiliar to you, I'm sure about that. He has introduced a brilliant concept of TechnoFunda Investing, in which he has integrated the principles of technical and fundamental analysis. And Vivek has been an active investor and an active mentor since almost 15 years. And he has made his mistakes. I was reading in his bio, and he has emerged a winner from there. And now he is on a mission to empower so many other retail investors to, gain their financial freedom. So rest of the journey and rest, Vivek, we'll listen from Vivek. So welcome, Vivek. Thank you so much for joining. It's been long due and we're finally glad to have you on our talk.
Yeah, thank you so much, and thanks to the FinMedium platform for having me. Yeah, and thanks for the awesome introduction. Again, it's not like a winning journey; it's still a path. It's still learning journey rather than a winning journey. So that is what, as an investor, we need to continue to do.
Yeah. So, but I'm sure whoever has taken your courses, your workshops, your sessions, they've all gained something, and you're genuinely I know I have attended your classes and sessions, and you're genuinely and very passionately encouraging others on the path of financial freedom. You're really like pushing them that this is possible, so you can do it. So yes. that's a wonderful initiative from your end. So
yeah, thank you so much.
So how did this come about, this TechnoFunda? This is, a very unique principle. You're combining two absolute parallel streams. So how did this come about?
So the concept. Journeys, I think the process started back in 2007. So when I started my journey, I started with reverse things. So most of the people, or investors rather, start with cash market. Then they take leverage, they go into margin, and then they probably, want more returns, more fast returns, and they go to, futures, and then they go to options because then they want overnight money probably, right? So my journey has been slightly opposite. I started with option selling, option buying, then went to intraday, and then went to the cash market and made so many mistakes when I started. And thankfully, that time I made mistakes because the capital was still low, and I could afford still to lose money at that point of time. I was still earning, and still the earning was relatively much lower. So had I would have been done those mistakes now, it would have been very, very difficult mistakes for me in terms of capital erosion. So that is the starting point. And then, somewhere I realized that one, it is not syncing with my personality in terms of doing F&O and, watching the screen constantly. And second, even on the investing side, when I started, it felt like I'm not doing something right, because in the just up move of the bull market in 2009, when the bear market just ended, still I was somehow not able to make decent returns. I was still struggling to find a good alpha in my portfolio. So that is where I consciously took decision that I need to learn and understand this game before playing this game, because just like any other game, whether it can be cricket or badminton or chess, if we don't know the rules and we just randomly starts playing, then the odds or the probability of winning is much lower, right? So that's what the thought process came in. And then I was fortunate to join this course with Narsimanji for 2 years. It was MBA in Capital Markets affiliated with BSE. So the curriculum was designed by BSE. And we had top-notch faculties, most of people who were practitioners in the industry, who were teaching us all the things we need to know about capital markets. And that is where really, that trigger generated, where we had in the course itself all about financial statements. We had things around, valuation, fundamental analysis, fixed income. We had technical analysis as a subject. We had SEBI laws as a subject. So what happened was simultaneously I was exposed to both these streams of thought process around technical analysis and fundamental analysis. And most of the times what happens is, as an investor, we are primed that okay, if you are an investor you cannot look at technical analysis, wo to traders ke liye and intraday ke liye hai, and as an investor we don't need to look around it. And that's why we probably don't even touch that stream or try to understand that vertical. But this was more like a forceful thing where I learned during the curriculum, and I found it amazing because one of my professor who was teaching, he was a practitioner again. He is at an age of 33 years, he achieved his financial freedom just by looking at candlestick charting. So I thought, there's something brilliant going around it. If I can see people who are practicing fundamentals, they are achieving their goals, and even technicals, they are achieving their goals, then why not just understand it? And that's where, I started realizing that, in fact, these two things are complementing each other. There are a lot of things like understanding the business model, understanding the sector that is covered in fundamentals through which we can build conviction. And fundamentals has its own drawback. Like I've gone through more than 50 books in my CFA curriculum, but there is no way where it precisely objectively tells you when to enter, when to exit, and rule-based systems basically. So that is what I found fascinating in technicals. And in fact, we go more long-term horizon on the charts, it is even more noiseless and beautiful. If you see like Asian Paints chart, it will be like a 45-degree chart. So you can easily say that it's a compounding company, right? You don't need to even look at balance sheet or financials or cash flows over 10 years. So that is what amazed me, that there are complementing things between technicals and fundamentals which we can leverage and get a better edge versus the market. So that was all the genesis of TechnoFunda, the blending of both the streams, and then it's practice and fine tuning and learning from others and evolving in the journey.
Wow, wonderful. So basically, you used technicals to reinforce the fundamentals, or
Correct.
something like that. Yeah. So, but who were your mentors during this period? Who really inspired you, or who you really drew some great motivation from?
Oh yes, so I have like a hell bunch of mentors from which I keep learning, and from the value investing side, I think deeply influenced by the work of Professor Sanjay Bakshi. When he wrote the article around VST Industries, and that was fascinating, and then kept following him, and was fortunate to spend some time with him when we had a VP Chintan Baitak in Goa. A lot of interaction in terms of what he thinks around fundamental analysis. Then, in terms of technicals, I have my mentor Sanjay Ved, who actually taught me the candlestick charting. Then, there is on the behavior side, my mentor is, Amay Hatangadi, who is a MD of Morgan Stanley. I learned during my college days behavioral finance from him, and he influenced greatly. And then one of my professor who was a practitioner of value investing, he taught me a lot of principles around what is growth investing and how you can think about it and what are the different rules around it. And then the entire VP community, Ayush Bhai is there, Abhishek Basu Malik, and even the CEO of Malabar Investment. I had also chance to interact with him, and again, he is more of a growth investor. We also had Hiren Ved coming in, our VP Chintan Baitak last year before COVID, and learned a lot of things. One predominant thing I learned from him is, in India, versus the cigar butt or the cheap kind of valuation, versus that, the growth investing will always be favored because we are a growth country. And that was like mind-blowing insight from him. And that is where, the investing environment or the culture, I think it's so conducive in India that we tend to, in fact, learn from each and every person in the investing community. They might not be the mentor, but even small one thing we pick up from them, it takes us to the next level.
Absolutely, absolutely. And yes, some of those names even I'm following, and really getting a lot of insights and information about the markets, about the style of investing. So yes, I am sure Vivek, in the beginning, we were discussing about how you made mistakes and, initially. And so, for a retail investor, or even for you at this moment, how are you managing risks? How are you managing not to let your capital erode? And, markets are volatile, and you cannot swear by what is going to happen the next day. Is it a
Yes.
correction phase, or is it just profit booking? You don't know any of these things. Nobody knows actually. So how do we
Yes.
manage? How does a retail investor manage risks in this kind of a market?
So the slightly longish answer, what I do is basically, as you rightly said, as an investor, we only control risk, and risk control is basically in terms of your position sizing and the downside which you have in terms of your positions, right? So these are the major two factors, and of course the allocation in the portfolio overall. Like even if you have a big position sizing, what is the overall allocation and construct of the portfolio, which a lot of people actually ignore. People majorly focus on what to buy and stock ideas and doing research around stock, but hardly people think about allocations and position sizing and all that elements. So in terms of specifically my portfolio, what I practice for managing the risk is a two-sided approach, which is called core satellite approach. So I have like 70% of allocation, which I call a core portfolio, and I have 30% allocation, which is called satellite portfolio. Now the core portfolio is mainly more like a proven winners. You can think like companies like Astral Poly or Asian Paints or Pidilite, which are having a track record of many years, and people call them with a different name. Some call them coffee can investing, some call them consistent compounders, some call them gorilla investing. There are different names to it, but basically these are all proven businesses which has been there for decades, and they've got strong competitive advantage which are backing them. And then there are a lot of emerging winners which has proven their track record for like 5-7 years, but they are not still a decadal players who have over decades showed their track record. So that is where that these are doing all the right things and they are growing continuously, but still they are yet to prove that highest category of investing style. So that is both these kind of companies form part of core portfolio, where you have very good understanding of the business. You have a good faith that okay, these are all going on the right track, and the possibility of loss of your permanent capital is much lower. Now, how to think about risk management over there? So if you think about these kind of compounding companies, there are two major kind of risk, right? So one is you probably enter in a very bullish market. Like right now, if you enter some companies at 150 PE, you might not exactly make returns which is equivalent to the earnings growth. Basically the idea is these businesses over a long period of time will match the earnings growth kind of returns. Now if you enter at a higher multiple, the returns will not match the earnings growth. It will be slightly lacking it. So that is one downside which you face. Second is if the earnings itself falters, so somewhere like we have seen like Eicher Motors in 2018, La Opala in 2016, Page Industry in 2018-19, that somewhere the earnings degrowth starts. Now market is expecting these are like consistent compounders, 20 years it will go 20%, 25%, and suddenly you see like 10% growth, and entire market is amazed at what happened. So either because of the degrowth, the derating will happen, which it is again dangerous if you have entered at a higher rich multiples. And second thing which will happen is time correction, right? So my focus on the core portfolio is to avoid both these things by using technical analysis. So I basically use some of the indicators which will take me out if there is a prolonged consolidation and if there is a downtrend which starts. So basically the two main key risks which are there in terms of the core side of portfolio that gets mitigated or gets reduced to an extent. Again, these exits are not like 5% stop loss or 1%, 2% stop loss how traders do. This could be very well 30-35% kind of drawdown, and you very well give like 6-8 months of consolidation to again see whether the company comes back on its track or not. So it doesn't take you out for that long period of time. And then the satellite part of portfolio is where it is more of businesses where it is probably a mean reversion kind of play, which is not a compounding play, but it could be mean reversion play, or it could be a play where you don't know whether it will mean revert or it will start more like a compounding company, right? So it could be your cyclical sector where upfront that these sectors will again go back to mean, or it could be companies where you're not sure whether these are like emerging winners or definite winners. You want to experiment, you want to see the execution, and if things play out, it could very well be in a core portfolio after a few years. So it could be like something which is 10% ROC going to 18% ROC, and then steady state ROC of 20%, or it could be something which is having a good decent ROC, but growth was not there, and now suddenly because some triggers in terms of sector or company plays out, you might very well grow in a nice way. So these are more experimental bets where you start with a small position sizing like 0.51% allocation, and then scale up your position as the company executes, as the performance starts coming in. And that is where the risk management gets capped, because if something goes wrong and you're not made yet the returns, only your 0.5% of allocation is at stake. So even if you hit like 30% exit, you are still losing like 0.15% of your capital. And at the same time, in terms of cyclicals also, sometimes there are news where things go wrong suddenly. There are supply side shocks which happens in the cyclical sectors, and most of the times by the time earnings comes in and the real picture on the fundamental comes in, the party is already over, the fall is already happened. So that's where again I use some of the technical indicators to help me mitigate my position sizing as well as risk.
Well, that may have been a little technical for a lot of our listeners, but yeah, but definitely I got a hang of it. And so for a retail investor, how do they combine technical TechnoFunda? How do they, for a retail investor, what is their takeaway from the techno and fundamental approach? So basically you're saying that fundamentals is what to buy, and technicals is when to buy and when to get out. But how does a retail investor understand this?
Okay, so see, simply for retail investors, I think in terms of core portfolio, you should have a basic understanding of the business models, whether over a long period of time they've done a good compounding. And again, I tell people that if you want to just simplify, just open a chart, put it on a monthly time frame, open a 10-year chart, and see if it is a 45-degree chart. Most likely, 90% of the times you will go right, and you will compound your money in a decent way. Again, because you have a portfolio of 20-25 companies, you will mitigate the risk. If one or two companies falters, then also you will be able to come out of it. And then for technicals also, a lot of people have this notion that okay, if you want to implement technical analysis, you need to know all the indicators and all the complex charting techniques. And a lot of people I've seen, they draw like 5-6 indicators on the chart, and the chart is like really complex. But I would say, as an investor, you don't need to know too much around technicals also. If you know 2 to 3 good indicators and master it, I think it's more than sufficient. So you can use as basic as something like a moving average, which can help you when there is a big consolidation and things go wrong. And when you go in a higher time frame, actually, it's like very peaceful way it will come out. So it is not like every day you will see fluctuation in and out. It is a very smooth process. And I use something called as 4-cylinder model, which is basically just to track earnings growth. There are like 4 components which I see, and it's very famous. I think each and every fundamental practitioners do it in one way or other form. Basically, you see what are the triggers for sales growth in terms of your existing business and new business. Like it could be a new geography or new product which is driving your sales growth. Second could be your operating leverage. Basically, how much is your fixed cost, and then on the fixed cost, how much you can scale. Third could be, your margin expansion. So because of your efficiency or raw material prices decrease, or because your, overall competitive advantage is increasing, how you are improving on the margins fronts. And fourth is how you are reducing the debt. So these are like 4 basic things you need to just check in terms of your fundamental growth triggers. And for technicals, you can use like 1 or 2 basic indicators. Like you can use moving averages, you can use parabolic SER, ATR. Again, the term might look slightly complicated for somebody who is just getting started, but just basic research and you will get to know what it does. I also have I think, video with Vivek Bajaj of Elon Markets, where I've given some examples. So you can also watch on YouTube, all those who are watching can go there and you can watch some of these live case studies which I've given. I think in Instagram it's difficult to share the charts, but
Of course,
yeah,
of course, of
their
course. But
users
yes,
can check it out.
I'm sure the combination, of how a few indicators, maybe it's operating margins or profit margins or debt reduction, etc., and then you short it out and then you use the technicals to enter or exit, at a particular time frame. So, Vivek, talking about the current market situation, it is all over the place. So, what do you feel? Is it current valuations? There's a lot of noise around that it is a highly overvalued market. So, what are your views on it?
Yeah, so I think, see, there are pockets where definitely there is euphoria and a lot of things fundamentally have got priced in. Overall, I generally don't try to predict the market, but how it looks like currently is too much volatility. So it's like both sides, wild fluctuations. Again, it's like just getting started. I think since long time, I think we have not even seen a decent correction, because if you have watched like 2017 or 2015 kind of market, within like 2-3 months, without any reason, mid caps can correct by 50%, small caps can correct by 60-70%. That kind of scenarios were very, very often in those years. But of late, I think since March COVID fall last year, we have not seen that kind of correction. So I think it's just a volatility that is picking up. I don't know if the direction will be a downtrend or uptrend, but definitely you're right in terms of different pockets. There is definitely a lot of growth and some kind of overvaluation that is getting built in.
So, what do you do in this kind of a volatile, overvalued sort of a market? Are you trimming your positions? Are you averaging up, or are you just sort of holding on to cash, waiting for like that solid correction of, above 30% or something like that?
Yeah, so see, again, I don't wait for correction or anticipate whether there will be correction or not, because I've seen some of my friends at 11,000 Nifty, they thought it is overvalued, got in cash, and still they are sitting and just watching the party, right? So it's very difficult to take that call, and that is where, consciously I've constructed the portfolio in the core satellite construct, that your 70% core portfolio remains intact even if the fall happens. In fact, it can be opportunity to buy in my core portfolio. But satellite is where, if there is a too much of volatility and I don't get entry, that pretty much 30% goes into the cash. So if the market keeps going up, that 30% will start getting utilized. And if there is a fall, it will automatically start triggering the exit. So that will create an automatic cash for me in the portfolio. So it's more like a dynamic cash hedge, which I've created built in within the portfolio. So that upside, I don't miss it. And downside, I take advantage. It goes into cash and I can deploy in the core portfolio. So that is how I'm playing out. I'm not timing the market or anticipating anything or predicting anything as such. So market will tell me if it needs to be. The satellite will go into the cash. Having said that, right now, in fact, the satellite itself is 20% cash. So like out of 30%, only 10% is allocated. Remaining 20% anyways is in cash as of now.
So what is the time frame for your satellite? I'm keen to know. Like, is it very flexible? It could be anywhere between 1 month or 1 year. What is the time frame that you keep for your satellite portfolio?
Yeah, so basically, as I said, the thought process for satellite is to find a potential emerging winner. Now, it could be like simply think about this. You are shopping something and you tested a new cloth, and probably you liked it and you got it, and after 2-3 days we felt like it's not matching the style or it's not the one which I wanted, and we basically give it back. So same way, the thought process is here. So you buy a tracking position, you see it for some time, and if it doesn't work out in your favor, you might exit very well in 2-3 weeks also. And if it starts playing out, the triggers go on, you very well continue to hold it for even 2 years also. So like classic example I think I can give is alkyl amine, which I got in my satellite portfolio last year, somewhere around April. And I thought all the triggers are playing out and let me just see how it works. And it played out, and still, I could ride till 2021 also. And then there could be so many companies which fail, and in fact the failure ratio is much higher because you are experimenting a lot of things. So you might have like two companies which end up for a slightly longish period, but for like remaining 8 companies out of 10, it may trigger for like 3 months, 4 months, 6 months also, you might get an exit. So you hold on basically those who are performing and where the triggers keeps playing up, and you get out of things which are not playing in your favor. So it's more like a laboratory. You keep doing a lot of experiments. The one which keeps working, you put more hours around it, and it syncs with the same philosophy which a lot of investors have talked about. Like you keep riding your winners and you cut your weeds. So that's the same thought process there.
Okay, so tell me two indicators that you use for which have been really a hit for you for an exit strategy. How do you leave that? How do you just get out of it? That has been a red flag for you.
Yeah. So I think, see, two main indicators, even this could be used on the core portfolio side, which I use is parabolic SAR and volatility stop. So let me just give you a brief context what it does. So parabolic SAR basically is an indicator which will give you a room until the upward movement is happening. As soon as there is a big consolidation, it will wait for like 4-5 months if it is a monthly indicator, or if it is a weekly, it will wait for 4-5 weeks. If the time correction happens after 4-5 periods, it will take you out. So that indicator you can use for a time correction. If, say, for example, HUL kind of scenario plays out, like last decade, it was like 10 years in consolidation. You don't want to stay in a company for 10 years without any compounding to happen in your portfolio, right? So that is where it will wait for some time period and then take you out. Other is when there is a downtrend that starts, and most likely in the core portfolio, it will be due to degrowth of earnings. That is the point also, it will take you out. And the volatility stop will basically do simply one thing. So it will see the normal volatility. So say, for example, you take Infosys. So most of the times it is fluctuating between 0 to 5%. It generally doesn't close 5%. So it will tell you that this is the average range in which the stock is moving. And then you do a multiple of it. So suppose you want to put a 2 times multiple, that only if Infosys goes down suddenly by 10%, I want to get out. Otherwise, I'm fine to even ride a time correction. So that is where, something like IRCTC happened, or somewhere like Yes Bank kind of scenario happens, it will take you out. Okay, because the volatility has suddenly increased and it has, the stock has started coming down. So
right.
You can use both of these. If you are willing to ride a time correction, then volatility stop is great. And if you don't want to ride time correction also, parabolic SAR can do best of both the things.
Okay, so tell me, Vivek, in your experience, you've come across so many investors and you've come across people who are learning or going through their investing journey. So what are the common mistakes that are made by the investors generally, and also while investing in cyclical stocks or commodities? So general as well as entering a cyclical stock.
Right. So let me take cyclicals first, because that is where people generally think after a good up move, they think that it is now a structural play and it is a compounding story, and 10 years it will remain the same, and all those narratives start coming in. So what happens is, cyclicals, the earnings are fluctuating, right? So it could be a loss-making company becoming a highly profitable company, like we have seen graphite cycle in 2018, where the companies were struggling to even make a decent EBITDA level profits. And then suddenly, they are highly profitable, the margin shoots up. And what happens is during the up cycle, the price to earnings multiple actually go down, because the earnings are at its peak, and most of the market players knows that this is a cyclical and that earnings will reverse to the mean. So they basically don't give a high P in anticipation of a mean reversion of the earnings. Now, a lot of people who read Graham and they read Intelligent Investor, and they think now I have done my part and I've now become intelligent investor. in the bull market, they will find for all the kind of low P kind of stocks. And all the good companies like Astral and Pidilite and Asian Paints, which are really good compounding things, they are highly, valued in terms of PE multiple. So they will think, this is not intelligent investing. I'm getting some stock which is growing at like 30-40% at 4 P. So this is like a great value buy. Let me get in there. Right. So they basically get in at a peak of the cycle, at the peak of the earnings, and then it starts falling basically. And then the biggest mistake after that they do is, now I should
Add more.
average my price down. So they will keep buying in the entire down.
Keep buying,
Okay?
yes.
And I've also done this mistake. It's not like I have not done that mistakes. I've also learned hard way. But this is like a classic thing which people do in the cyclicals. And during the entry, the opposite happens. The earnings are depressed. It is almost recovering from the loss. And when people look at PE, they feel, okay, steel company, loss-making company, but 40 PE it is trading. Because market is again factoring the mean earnings, right? And they feel like it is a super expensive company and I should not get in. It's a cyclical company, bad business, loss-making company, or just recovered from the loss. Why should I buy it? And that is actually the time to buy, because that P, although it will go from 40 to 4, but that will be from the virtue of exponential earnings growth. And if you can ride that, it can very well create 5-10 beggars also in your portfolio. And that is also the thought process to play that in satellite, because if you get it right and if you have exit strategy in place, it can create a big alpha, which generally the consistent compounders might not create, particularly in the highly overvalued bull market.
So which cycle is now starting? I'm sure I've got questions, so I'm just taking one of them. So which is the entry point in which cycle that is starting now?
So I think, see, some of the sectors which did not participated after the COVID kind of fall, that has now started to pick up. So your classic sectors like hotel industries, real estate plays, and even textile for that matter has started showing green shoot. In fact, when I'm talking to a lot of ground level industry people and some of the employees in textile spinning industries, they're pretty much saying, we are booked for almost like 6 to 12 months. So that is the kind of order flow they are seeing. So these are like pretty much some of the, mean reversion kind of sectors which have started to picking up. They pretty much did not participated last year. And also some of the other mistakes which I wanted to just discuss before we move sector specific is, a lot of people stay away from averaging up, so they buy a good company at a good price. They do sometimes luckily or sometimes knowingly value buy, like buying say for example Astral at 800 rupees during COVID fall. And then company starts delivering the numbers, the business performance is intact, the compounding keeps happening, but they don't buy or top it up at a slightly higher price. They always think that, it is expensive if I buy. Basically the price anchoring, right? You feel like if I bought it at 800, I'm fooling myself if I'm buying at 1,000 rupees or 1,200 rupees or 1,500 rupees. And that is where, even if they ride these kind of good winners, they basically have a very small allocation. So even if you like make a 10x on a 1% position, it doesn't move the needle, right? So if you really have got winners, we need to back it up with capital. So that is the whole idea in terms of position sizing and allocation, which people miss out. And the other mistake a lot of people do it is they get into right company, and suddenly, because the trigger starts playing out, probably again knowingly or luckily, and there is a swift move of like 40-50%, and then people panic that, okay, now it has moved too fast, too much, let me get out of it. And they don't focus on understanding what are the triggers that is playing out really, whether the earnings growth is happening much drastically than they thought earlier, or it is just euphoria. So that is where it is very important to keep riding rather than just getting out very early on.
Right, absolutely. So, Vivek, I've read a few of your tweets, and you've been talking somewhat about the platform companies, IEX, your CDSLs, NSDL, and they've also for for their sudden up moves, they've also come under the government scanner. And so, what are your views on that? Is it a caution move? You have to just wait and watch, or is it a good long-term move? How would they play in the future?
So as a theme, the platform theme is like something like how service industry or the internet industry back in 1995 started. So basically there are four phases of economy which our generation has seen, like even the previous generations, I would say. So the earlier economies were agri economy, right? So when typically in the 11th 12th centuries, it was predominantly agri economy, and everything was surrounded by agriculture. Those were like rich people, those were all zamindars and people having big land masses. Then the came age of industrialization, typical 16th century, 17th century, and we were also victim in India of this industrial age where countries were hunting for raw materials and they did colonization and British ruled our country here, right? And then even if you see the richest people during that era were all these Jamshedji Tata and all those category where they produce something, Bajaj of the world and
Right.
the Mafatlal group and all those who were producers and industrialists, and even Dhirubhai Ambani for that matter. And then the era of service industry started, where we saw likes of TCS, Infosys, HDFC Bank, and even the US economy became superpower because of service industry. Their 56% of GDP is just dependent on service industry. So
Yeah.
that is the emergence we saw in previous decades. And now if you see the emergences of platform businesses where, I keep telling a lot of people whom I interact or other investors that you can love them, you can hate them, but you cannot ignore them, right? Like it's a classic Apple quote where, when this computer age started, this was quoted by Steve Jobs. So same thing, it's happening. So it's happening in front of us, and we all are part and parcel of this economy. Like if you watch a TV, you are consuming Netflix or OTT platform, that is platform. Right now, what we are doing on Instagram, that is platform. If we are ordering some food on Zomato, that is platform. If we are searching something on Google, that is platform. Right? If we are ordering something on Amazon, that is platform. So it's like we are surrounded by these companies. So we cannot ignore this mega trend. It's going on in front of us. And if you see, almost 80% of the transactions or the activity which we do on the day-to-day basis, it is on one or the other platform kind of businesses, directly or indirectly.
Yeah.
Right? So the theme is there, but most of the times when the theme starts emerging, what happens is sometimes the market gets too much euphoric and the fundamentals start, going beyond, or the price goes beyond the fundamental for short period of spends. Like we saw that in dot-com era, right? So from 1995 to 2000, a lot of these dot-com companies started running up, and you will have all these,
Yes.
quasi, hidden companies which will just put .com in front of them, or company which will put platform in front of their name, and people will start re-rating them. That is a known phenomena that will happen. But now if you look back and take the analogy of the IT bubble that happened, even Infosys was valued at like 150, 200 multiple. TCS was valued at 150 multiple. They were growing at 100%, but the valuations were much higher than their growth. Now, although the bubble bursted, although the crash happened, can we say TCS did not create wealth in last generation? It's one of the biggest wealth creator in India. Infosys is one of the biggest wealth creator, right? So all these IT companies, even Google is biggest wealth creator, right? So all these companies were actually participating in .com, and today if you see, even I have a website, right? I have a .com website, and a lot of small SME companies have a website. So it's not like the trend did not play out. It's just that, sometimes the market becomes too euphoric that everything and anything they will paint it as a .com or a platform, and then they will keep giving absurd valuation, and then again the rationality will prevail. But having said that, you cannot ignore the trend that is playing out. So that is the whole idea, that mega trend is there. You need to choose carefully, and the biggest, again, the delta for this particular thing is the platform business is like a winner takes it all kind of a business. So it's not like everybody
Yeah.
wins. So only one or two major players will actually become market leaders. Like we have seen Uber and we have Ola. There are only two taxi aggregators. There is no third player. Same way, in e-commerce there is Flipkart and Amazon, which are predominant players. There is
Amazon.
no third player, right? So the consolidation will happen. A lot of losers will get out of the market. Like there were so many e-commerce platforms, right? If I remember, eBay also started in India, did not work out. Then there
Yeah.
was ShopClues and a lot of platforms which were there, which died, right? So a lot of companies will die, and that is where the position sizing and how you average up in the business which are winning and have a risk management that will be very, very critical to play out these kind of businesses.
Right, right. Yeah. That's absolutely, I think, yes, one has to be very watchful, but you are right, we cannot ignore them because they're right. In fact, there's so much talk about another, Nykaa coming with this huge IPO, another, big e-commerce business, then Paytm and Policy Bazaar. So you name it and they're all over and the kind of valuations they are. So one has to be careful for sure.
Yes.
Uh, but definitely cannot be ignored.
And
So,
another
I
interesting thing is the
recently, yeah,
scalability. So that is also a biggest trait. Like in India, what we have seen is there is always difficulty to do businesses and scale, right? There are so many operational hiccups. There is so much of red tape and bureaucracy. Although it has decreased, but still,
yes,
it's very tough to do business in India. And that is the reason almost like less than 5% of the companies in India are making a PBT of 200 crores. Right? So it's very, very difficult to scale in country like India. And now you have these new age businesses. We don't require capital to scale up beyond a point, right? And they actually
yeah,
don't sell any product and they can scale very fast if they actually win. Right? So they can even grow 100% by just opening up a new vertical. So in country like
yes,
ours, investors will give more premium to these kind of businesses because traditional businesses have been struggling to scale up, right? So that is another
yes,
angle to look at it, they are pretty much replacing the old economy ways of doing things, right? So that is where the
yeah,
excitement will
absolutely. In fact,
definitely be there.
yeah. In fact, there was a talk in one of the conferences day before itself, and they were discussing that how practically it is not, so much capital is not required for scaling up, whereas a traditional manufacturing will require a huge amount of capex to, think of scaling up at this stage. So that's where they have a fairly big advantage at all points. So yes. So Vivek, you recently had a talk with Mark Minervini, and was viral actually. So for those who don't know, Mark is a technical analyst and has written some great books about it. So what was your one big takeaway from that talk, or what was the learning from that recent talk?
Oh yes, that was wonderful, and never thought we'll be talking face to face with Mark, at least on Zoom. But it was amazing, and he's very grounded person. Although he's a multiple times U.S. investing champion, and he again
Yeah.
follows both technicals and he also looks at fundamentals. So basically, there were so many learnings, but the biggest learning and the takeaway was he mentioned two words, which is respect risk. Okay, so that is very, very critical. And most of the times,
Yeah.
we as an investor, we always think about what are the returns I'll get, whether it will become multi-bagger or not, whether this company will give huge portfolio returns, but barely we think about risk. So his way of thinking is, first you respect risk and understand what is the risk in your positions and what you
Right.
are doing,
Right.
and then upside will be taken care automatically. And if you think about it, upside we don't even control, right? We only control risk. I cannot
Yeah.
control how TCS management will play out, or how their business will work out, whether they will get more customers or less customers, whether Nifty returns will be 10% or 100% next year. We cannot control that, right? It's like very, very
Yeah.
external factor. The only internal factor which we control is risk. And most of the times we
Yes.
blame external factors. We say that, okay, this particular minister announced this news, and because of that, my stock crashed and I made huge losses. This company was doing capex, they did not get environmental clearance, and now I suffered losses. Nifty was going 15% every year. This year it went negative 20%, and I made a loss. So we always, tend to blame external factors, but the external factors are not in our control, right? And pretty much everywhere in life, right? We cannot control somebody outside what they are doing. To an extent we can do, but not beyond that. So only thing we need to do is how we can manage, and internally how we can optimize with that situation.
So follow up to that. Now, what is, as on today, the kind of rage the stock market has invited? I mean, people have opened demat accounts left, right, and center, especially since this, they've been working from home, so they think this is easy money, and the bull market looks very inviting, and they say, oh, wow, why am I even in a job when I can earn these kind of returns? For a retail investor today, in the kind of markets we have today, what is your advice?
Okay, so basically, see, although I'm a full-time investor, but I generally keep telling people that for investing, if you build right kind of system and process, you actually don't need to do full-time. Okay, so even I keep on doing a lot of things, and things which I love to do. I'm also writing a book as we speak. So all those kind of hobbies you can chase if you are full-time, but you actually don't need to be a full-time investor if you are having a proper system in place. That is first thing. So focus on your core compounding, because that is where the capital will get generated. And for investing, raw material is capital, right? So if you start generating capital, your compounding will not work in efficient way. So focus on core job or business, whatever you are doing. That is the first message, and be good at it. Improvise the skill, get that next promotion, get that next hike, and all those things, and try to maximize your invested capital. So even if there is a slightly lesser return in one particular cycle, you will still compensate that with a initial backing of capital. Second is we need to understand ourselves, what we are, and what is our personality, right? So a lot of people have seen, when things are right, they feel, I'm a long-term investor, I'm willing to sit on this for 10 years, and then 5% correction, and they start panicking that what happened, whether I'm right or wrong. Right? So that is where, probably the allocation is not in the sync, or their personality is not in sync. So we have to have either personality and allocation both in sync. A lot of time, people get swayed away with the bull market, and they feel, everything I should put in equity because it's generating like 50% return every year, but my FD or fixed income is generating 6%. Why should I put any money out there? And then hits the bear market, and they realize the importance of it, right? So no matter what is the cycle, we need to follow the asset allocation. And I think I've done a detailed podcast also on this, like what you should be doing when there is a bull market, because it's very natural to get swayed away and again forget risk many times, that okay, there is a risk embedded. Equity is like an embedded risky asset class, right? So we don't need to forget that it is a risky asset class. Again, don't get swayed away by euphoria also. A lot of time, we get swayed away and we keep putting capital and realize, this allocation is like 20%, and then it falls 50%, and we lose our shirts and pants. So that is where, have your caps that, okay, in one company, I'll put like 5% to 8% capital. And if that is done, you need to be disciplined that, okay, now my rules are getting met, and now I don't need to breach my own rules. So have a system in place which is in coherence with the personality. That is very, very essential thing. And take time to learn. Don't just think that I am like, if you read one book and watch one video or YouTube video, and don't think like I know it all, because we don't know it all, right? Even after spending 13, 14 years, even I feel like always, there is something new to learn and something new to fine tune and understand. So keep learning, but don't think, get in ego, and that is again a very psychological trait. We fall in ego that, I know it all, and, whatever I put money, it starts running. So I'm like God, and that is not the case. We need to be very humble. We have to keep ego away. And if things don't work in our favor, we have to cut our positions, exit, manage risk. All these things are very important.
Yeah, so this bull market has churned out a lot of stock market and trading gods, and I really hope and I pray that they actually, you know, follow the disciplined and the patient way of investing, and learn before they actually think that they're ready to throw away all that capital, hard earned money. So as we are talking about learning, and you yourself are writing a book, do you want to suggest a few books that the must reads, or something that you've read multiple times, or it has to, it's like the Bible of investing for you?
Yeah, so first of all, I think in terms of personal finance or the money mindset, I think two classics are there. Richest Man in Babylon, which is more of a story format, very easy to read, and also pick it up and read in a day or so. And then a classic Robert Kiyosaki, Rich Dad Poor Dad, which is more on the personal finance psychology side of it. If you think around core investing, I think there is a book by Pat Dorsey which is called Five Rules of Successful Investing. There is a book by Peter Lynch, One Up on Wall Street, which is also very good. Then you have our own Indian author, Coffee Can Investing, which talks about how compounding in the strong plays work. It is also a good book. On the cyclicals, if you want to understand the capital cycle, there is an amazing book called Capital Returns. And then there are these Mark Minervini books, which are again good, which gives you idea about how to manage risk and some of the position sizing. And then I think there is this book by Howard Marks, also The Most Important Thing, which is very
Most.
important if you want to learn like second order thinking. And again, he talks so much about risk, and he also talks about cyclical companies and how to play about it, because he has successfully, although he's a value investor, he has played a lot of cyclical companies successfully. So a lot of time we have this block again that if you are value investor, cyclical companies is like bets and speculation, but it's again a value play, because you are playing that value migration from a mean reversion perspective, right? So that is also a good book. Apart from that, I think I'm also reading, and yeah, this book on growth investing by Terry Smith also is an amazing book. Definitely must read, because that will open up the mind block of coming out of that Graham style of cigar butt investing to more of a growth investing style. So that will also help. I think in Indian context, it is really awesome.
So when can we expect your book to be out?
Let's see, we just completed first chapter, so hopefully in 2 to 3 months, if everything goes fine. So maybe early 2021 or December end. Let's see.
Oh, wonderful. So we are all looking forward to it. So I think you've really given a very heartfelt and insightful talk, Vivek, and I'm sure it's been very enriching for everybody who has joined, and a lot of people joined today, and everybody's just appreciating the inputs. And so thank you so much for being here today. We overshot the time, but yeah, it's
So it's fine if you want to take like 5 to 10 minutes question. Also, it's fine. It's up to you.
Can we take a few questions? I was going to ask you that. Can we
Yeah.
take a couple of questions that have come? So one question that has been asked a few times, I think, since we are talking too much about stock markets and particular stocks, somebody asked me, what with the name of the stock, they want to know the mistake you made with some particular stock earlier in your times, or you went totally wrong with that.
So many of them actually, and some of them are not even listed. So initial, when I started my journey, my first stock was Karuti Global. Again, the story or narrative was it's the biggest flower exporting company from India. It's a Bangalore-based company. I think it's probably delisted or still listed. I don't know, but it has like huge wealth erosion it has done, and the narratives was right. It was not like it was not the biggest exporting company, but that time the ROC and the cost of capital and competitive advantage, all those things were not known. Then second was Alok Industries. So this was suggested my dear broker from ICICI Direct, and he told this is a great company, textile play. They have used land bank, but the promoter did not turn out to be right, and now we all know it went to NCLT, acquired by Reliance. That was a big wealth destroyer. Then there was a narrative around Opto Circuit. It was a medical device, I think manufacturing company, one of the biggest in the world, and even some of the FIAs from Hong Kong and all that had invested. Lost huge again, bought at 200 rupees. Now probably it is trading at like what, 10 rupees or 5 rupees. I don't even track them. I have one shares of each of them, by the way, just to realize that I made this mistake. I don't need to do it again. And then Reliance Power, Suzlon, that were again high flyers during those times. Later on, Ashtvinayak, because of all the Bang thing, again got swayed away. And again, that got delisted also. I still have one share of that. So a lot of such mistakes, it's like so many mistakes I might have done. And that is the reason, I try to connect with people and share those learnings as much as possible so that they don't need to make, although people will make mistakes, but even fewer mistakes will save a lot of capital. So that is the idea. But yeah. So many such mistakes which I might have done actually, and the narrative was all in place. Biggest Suzlon was like biggest renewable company, like how we see Adani Green narratives and all those right now. Same kind of narratives, that biggest renewable company, renewables is the future. And Unitech is the biggest landowner, and Noida is growing left, right, center, and it will be biggest beneficiary. Infra story, and then Opto Circuit, similar lines. And then there was a company which was manufacturing, I think, these Aadhaar-based OTP confirmations and all that. I'm forgetting the name, but that same thing with that particular company also. So the narratives were all in place, but it's just that the finer picture probably I didn't realize that time, and didn't know how to analyze a company fundamentally, did not have a exit system of technicals in place. So yeah. And even this thing, which was this the retailer where which started initially, where you can buy clothes, and it was a retail chain, one of the biggest retail chain actually. I'm not remembering the name again. It was a very big wealth destroyer. I think it was at 1,000 rupees. And then Coutons, Coutons. So Coutons was the biggest retail chain that point of time. From 1,000 rupees all the way to, I think, 10 rupees it went down in very few short period of time actually. So yeah, a lot of such mistakes, and also averaged down in these companies. So that was even biggest mistake after that.
I kept adding more.
Yeah.
So I think another question that we've got a few times is about the real estate sector. So it's been like, it's not really performed in the past few years, and now things have started looking up. Some of the stocks like even Oberoi and Oberoi Reality and a few more, even DLF, etc. They've started showing up. So is it like an up move from here? And what are your views on the real estate sector from now?
See, ground level, I think it's picking up. So I keep talking with a lot of sites of these real estate developers. So in my city in Bangalore, I probably check it out once in a while with all these different project sites which they have. I just check how many units they have sold, and I just ask as a customer and try to see. Sometimes I do a phone call, or I tell my freelancer to just do a quick call and check what is the ground level thing which is happening. And at the same time, a lot of group people in my community who are there in different cities, say somebody in Noida, somebody in Mumbai, somebody in Pune, I also tell them you just do a ground level check to just validate the sales data and how things are moving on the ground. So I think see, one thing is very clear, and I have a lot of friends in real estate development also, who used to do steady one or two buildings alongside these big chains of builders. They have now got fed up with all the compliance and the RERA and difficulty in terms of raising capital and meeting all the standards and still making money. So a lot of these, standalone builders are getting out of the system. That is very much evident. And this is not just one city. I've seen from multiple cities, multiple connections. I've heard this. And on the other hand, these guys, the cost of borrowing has been in teens, it's like single digit kind of cost of borrowing. Like if you see Godrej Properties and all that, they are able to borrow at like 6, 7, 7.5% kind of cost. So they are getting disproportionately advantage. Now, what has happened is like last 1 or 2 years, because of COVID, people got some bit of capital because you are not traveling, you are not going out for food, and you're working from home. So this down payment kind of capital has been there, which is generated, and that
Generated.
triggered a bit of buying. And overall, the cycle has been lackluster. So the pricing did not move up since many years. It was more into time correction. So I think things are picking up, but how much it will pick up in future, whether it is like a temporary spurt or it will be a big cycle, because real estate generally is a longest cycle. If it plays, it plays out for like around 6-7 years also. So let's see. I think right now all the things are in place. The interest rates are also at bottom. So all these things are perfect recipe. Let's hope. So again, I'm playing that in satellite, and I leverage up if it plays out. If it doesn't play out, need to get out. And some of the proxy plays also, it's good to consider rather than playing direct real estate, because the ROCs and profitability of real estate is not that great historically. So rather than directly playing the sector, I think proxy play might be a better way to go about it.
So maybe the tiles manufacturer and a pipe
Piping
manufacturer and the
companies,
back end,
yeah,
yeah,
sanitary
wires
wares,
and electric, yeah, yeah. Makes sense, makes sense. So we are also getting a lot of questions on particular stocks, but I think we'll avoid them because then it'll go on till tomorrow, our
yes,
discussion.
yes.
So I think so yes. So thank you, Vivek. I think it's been a pleasure, and it's been a really insightful. I'm sure each one of us is taking back something really significant from this talk. And thank you for your time. And I hope we'll do this again soon, very soon, and we'll have more detailed discussions on other a lot of other things that we couldn't talk about today. So thank you so much. Wish you a very, very happy Diwali, and wish all the people who have joined us today a very happy Diwali. So thanks a lot, and yeah, any closing
Yeah.
thoughts?
No, thanks a lot for having me. And again, thanks to you and the entire FinMedium team, and festive greetings to all of you. Happy Diwali. And for all the listener out here, thank you so much for patiently being here. In today's time and age, it's very difficult to have a attention span of more than like 5 minutes. So we have been talking since almost like 45 minutes, and you have been there till the end. So thank you so much for being here. Hope we were able to give you insights and value for your time. And yeah, we'll stay in touch. If you're not following me on Twitter, I generally keep tweeting a lot of stuff rather than being more on Insta. So you can follow me on Twitter if you want to. My handle is Mashrani Vivek. And yeah, let's stay connected.
Thank you, Vivek. Good night, and good night to everybody who's joined us. Cheers.
Thank you so much. Take care.
Bye.